How's everybody doing? This is Bob Iaccino from the Pure Exposure Growth Series. Thanks again for joining us. Thank you to our sponsors, E-Trade Financial, where you can get pretty much anything you need, trading-wise, active investing-wise. The facilities they have, I think, are unmatched. And CME Group, thanks again for sponsoring us. And with me today, I have my, I can call you a friend, can't I, Scotty? Scotty?
I think we are.
President of Prosper Trading. And Scott, there's a ton going on between what we're looking at with the moves in precious metals, what we're looking at with the moves in the dollar, the sell-off we have Thursday and Friday in the equity markets, the deadline for the extension of unemployment benefits, and another stimulus package now talking about 1.5 trillion. Just give me real quick, 5 seconds, what's on your radar, because I want to get right into the markets with you.
Oh yeah, and then we have the Fed and we have all the big earnings this week too. So you know what, everything is on my radar, but this week it's really got to be about earnings, even though we're seeing this just incredible move in both the dollar and gold.
So what do you think about where this is at now from a perspective? Let's talk precious metals. I mean, you and I both know about the historical inverse correlation between the dollar and gold, specifically silver as well to a certain degree. Do you think that the dollar continues lower, and what's the pressure of that? Is it just U.S. stimulus, or is there a view that the U.S. is doing something else wrong?
You know, I think it's two things. It's stimulus, but I think it's more so that the rest of the world has now taken the opinion that maybe this is not the safe haven. You know, when we had the shutdown 3 months ago and the concern, which we still have, but the real concern, the real, let's call it, I'm going to call it neuroses around the world about COVID. Where did people flock to? People flock to the dollar. Now that that is abated a little bit, now that that has eased a little bit, and I'm not talking about the severity of COVID, but I'm talking about the fact that maybe the U.S. is not that go-to, that safe haven. To me, that has as much pressure on, downward on the dollar as anything else. And what we're seeing now is just this incredible run to precious metals, gold and silver. And to me, Bob, and this is not going to sit well with a lot of the gold bulls out there. I think we've come too far too fast.
Wow. So the new record highs are gold right now. For anybody that hasn't been paying attention, I can't imagine you haven't. Highest level ever, right? Gold is at a new record high. We've got dollar at 18-month lows. So when I was coming up, we learned that when you buy a currency pair, it's like buying a share in that country's economy. So is that where you're going with that? The NIB, I always forget those initials. National Bureau of Economic Research.
Something like that.
Yeah. The think tank or the institute that's officially charged with telling us whether we're in a recession or not has said we already are. And that's unprecedented. Yeah. Normally, they don't say we're in it when we're in it. So do you think it's more about that buying a share of the economy thing? And if so, we're in a recession, does dollar go lower?
Yeah, and here's my big concern, and I agree with that. My big concern is a week from this Friday. Not this Friday, but I believe that's August 7th, when we get the big jobs numbers for July. When we got the June numbers and everybody was cheering and they were great numbers, right? So way more people going back to work, which was phenomenal. However, those numbers did not reflect the last 2 weeks of June when the shutdowns started to happen again. I firmly believe, and I'm not a glass half empty person by any stretch of the imagination, I firmly believe that these July numbers are going to be a major disappointment. And I kind of see this dollar softening and gold just out of the gates here as a run up into that number that we're going to see right there may be reflective of what you're saying here in us being in a recessionary period.
All right. So let me ask you, this is 30 of the S&P reports this week.
Yeah.
Earnings. We've obviously got some huge names. I was talking to you before the show started, and I said, what are you focused on? And you said, I could give you a list a mile long. Give me 4, 5, 6 names that you think are the most important for the overall move. And it's full disclosure for people watching. I am a subscriber to Prosper Trading personally. People should know that. So I get your option signals. I love them. I don't take every one of them because I like to think I have my own ideas. But quite frankly, sometimes your ideas are better than mine. So if you can give me just sort of a list of what's on your radar and then maybe something specific you're looking at.
Absolutely. I mean, the big ones, which I think are going to tip the scales to the overall market, are obviously Amazon, Google, or Alphabet. We've got Apple. You know, stocks like that, you can't discount them. You have to look at them. However, there's a belief out there that big tech is in somewhat of a rollover right now, maybe a sector rotation. I'm not of that belief. I'm of the belief that the little bit of profit taking that we've seen off the NASDAQ and off of these big stocks over the last, let's call it week, 10 days or so, has been just that, has been profit taking. Now, to dig down a little deeper into maybe a name that people aren't as focused on, there's one after the close today, NXPI Semiconductor. From a fundamental and an analytical standpoint here, I think this stock is going to be rip-roaring ready to go here. It's coming just off of the 50 and the 200-day moving averages. The semi space has been just as hot could be. And to me, this is one, maybe not market moving in the terms of an Amazon, an Alphabet, and an Apple, but this is one to really watch to the upside.
So that's NXPI. Do you think,
yes.
So tell me, are the earnings are after the close today? So
yes.
Calls, puts blown out already? I mean, is there a way specifically to play it? I mean, you don't have to give us a specific trade, but you're not going to want to buy calls or puts on an earnings day, right?
Well, you have to watch the volatility. So that's why you're saying that. So what I'm doing, actually, what I'm looking to do is maybe buy some time, maybe buy a upside calendar spread here, selling really, really expensive premium for this week and buying not so expensive premium going out a week or two, but on the upside, maybe looking around the 125 or 130 strikes. Stock closed on Friday around 115. And I think that the price that was built into the option market for an expected move was around $8 or $9. It was like an 8% move or so. That may change early this morning or so, but 125 to 130 target for me is what I'm looking at.
Do you like that sort of indicator? I mean, the options volatility, the markets will say, Tesla last week, there was an anticipation of a 15% move on the options. We didn't get anywhere near that. Do you like that, or do you think it's stock specific as to whether it's reliable or not?
I use that every single day, Bob. I teach that to my students every single day because without going heavily into the math behind why these moves are priced in, these moves, which are based on volatility and what comes down to it are supply and demand in the marketplace, these moves are priced in mathematically with a one standard deviation probability or about a 68% probability. Doesn't mean they're going to be right all the time. In the case of Tesla, it was completely far off. So people that had sold premium, huge winners. People that had bought premium in Tesla looking for that big move got knocked out of the park. They just got absolutely annihilated. But I use that calculation every single day in almost every single setup that I use trading options to determine which strikes I want to trade.
So NXPI, of those big names you mentioned, the Amazons, the Apples, which one of those do you think has the biggest possibility of missing? And possibly, we obviously saw the down move that we got Thursday and Friday in the NASDAQ specifically, but in all the indices. You mentioned that you're probably still bullish tech. I'm assuming you take that across the market because tech's been leading. Is that right?
Absolutely. Again, I firmly believe that the little sell-off that we've seen has been more profit-taking than it has been sector rotation, because I look out here for the next 3 months, the next 6 months, even the next year or so, and you see I don't see the landscape changing. I don't know if you do or not. We all hope and pray that we get a vaccine tomorrow, let alone, a month, 3 months, 6 months, 9 months from now. We all hope and pray that that is the case, that we get it sooner rather than later. The reality of it is we're probably not going to. That, with the heightened sense of coming up to the election as well, I think tech is the place to be. I think some of the other big cap spaces here are going to struggle. I really do.
Yeah, Moderna got another, I think it was 472 million.
I see that.
Yeah. Do you have any opinion on any of the pharmaceutical stock? By the way, for full disclosure, I'm not playing them. It's just not a game I can get. I can't guess who the U.S. government is going to fund to the point and then buy all their vaccines after that. I don't have a guess at that. Do you have a favorite in there, or is that just off your radar?
I don't. No, I don't, because
Very smart.
like you just said there too, I don't want to flip a coin. And to me, that's a coin flip. Great. I may make it big one day and I may blow out the next day. So, if I see something that makes sense from a volatility standpoint, maybe I'll do something in one of those names, but it's impossible to pin any sort of, let's call it, inside knowledge onto where the Fed is going to, back the next pharmaceutical company.
Scott Bauer, Prosper Trading. Where can everybody find you? I know where to find you. I'm a subscriber, but where can everybody else find you?
Well, it's Prosper Trading Academy. You can go to prospertrading.com. Pure exposure, we're all over social media as well. But we do interact with our clients live on a day-to-day basis. Myself, our other professional instructors, and we teach people the markets.
All right, I've got to let you go. I'm going to bring you back though for a larger conversation, maybe with you and one of the other guests today. We'll probably get that done maybe this week or next week. Dude, thanks again as always for being here. We're going to be right back with Amelia Bourdeau from Market Compass LLC right after this quick break from our two sponsors.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
We are back. Thanks again to CME and E-Trade for sponsoring this. And I want to welcome in from Market Compass LLC, Amelia Bourdeau. Amelia, before we start talking, you're doing something else besides Market Compass, right? I want to make sure we get that out there.
Yes. So I am obviously with Market Compass, my macro and foreign exchange strategy, education and strategy firm. And I also work with Ex Ante Data. They're an alternative data company, and you can check them out on @XAntiData on Twitter. Start taking a look at our charts and our alternative data charts and see how they interact with financial markets. It's really exciting.
That's awesome. I can't wait to start looking at that stuff. So quickly, you're global macro. We want to talk about global macro. So, I mean, there's so much going on. I don't even want to list it out every time a new guest comes on. We've obviously got stimulus that has to happen, unemployment extension. Give us sort of your macro view and let's give it a minute and a half, 2 minutes, whatever you can do on terms of what's going on globally and then what's going on in the US with all the, I mean, there's too many headlines to list.
Sure. I mean, what I focus on at Market Compass is event risk. We obviously have a lot of event risk in the second half of this year. So on the positive side, what just happened, obviously in Europe, there was a marathon last weekend, there was a marathon European council meeting, and they came to an agreement on a recovery plan, 750 billion euro, and a new budget, 1.1 trillion euro. So this really lifted the euro, and I know you're seeing that. So this was something very positive. Back in the United States, we're looking at a second round now of fiscal stimulus. It hasn't been passed. It's debating back and forth. I believe it's weighing a bit on equity markets. And we're focusing on the second wave of coronavirus, which had been hitting the Sunbelt states. It's starting to recede. That's really good news. But I do believe that's impacting a little bit sentiment for at least the US dollar. Over in Europe, we really haven't seen a second wave of coronavirus, at least not yet. And we really hope we don't. But they've been having some good numbers in terms of PMIs over in Europe. And that's also kind of adding to some sentiment. Back here in the US, we also have US-China tensions. You saw that last week with the closures of the consulate, the Chinese consulate in Houston, and then another US consulate being closed in Qingdao in China. So a lot going on. We're also obviously heading into an FOMC meeting this week. Q2 GDP, which is supposed to be down like 34% annualized, is going to be released on Friday. It's backward looking, but you know, you never know what a big number like that's going to do to the markets to shake them up.
It's still important, right? Because what we're looking at now is data that's coming out versus expectation, even when they're
Right.
backward looking at kind of this GDP is the baseline that we have to build off of, right? We've got the decimation from the pandemic.
Yeah.
And this is one of the last baselines we need. We've got our non-farm payrolls baseline.
Right.
We've got our jobless claims baseline. But
Yeah.
in terms of, can you explain to me, because I was mentioning this to you when we were talking during the week, we've been long at the Stock Think Tank portfolio, which is the stockthinktank.com. We've been long the euro since
Yeah.
June 24th. We've been
Very
long gold
good.
since June 1st.
Very
But
good.
obviously you're a help in why I like the euro, because we talk all the time. But from the perspective of, talked about this with Scott Bauer a little bit.
Mhm.
When I was first learning markets, the first thing one of the currency guys told me was, when you buy a currency, you're buying a share in the country's economy. But then there's also the supply of that currency globally, which is, I would argue, is the main short-term factor, right? So
Right.
with that massive euro stimulus program,
Yeah.
why is the euro still strong?
This is really more than a euro stimulus program. It's a sea change, really, in the structure of euro and the EU, how the policymakers envisioned it back years ago when it started. So they said originally, and they've always said since until now, that there would never be a fiscal union in the euro area. And now with this new recovery plan, this is the first time Europe will issue a joint liability together. And so this is a structural change almost in the makeup, the beginning of a structural change in the makeup of how the Eurozone is going to now proceed forward. So they're kind of like breaking new ground. And so that gave sentiment in the euro a real lift. It's been lifted since mid-May, when kind of Merkel and Macron floated this idea. And then with this kind of historic European Council meeting last weekend, which ended this past Monday, a week ago, you know, the idea came to fruition, an agreement was reached, and then euro is, you know, overnight, it just broke 117 top side. So really strong sentiment in euro right now. At the same time, the dollar is declining. We've seen some dollar weakness that's broad-based, not just against the euro. And that has to do with kind of our reemergence of coronavirus here and our inability so far to pass a new fiscal package when unemployment benefits roll off July 31. It's just making the market nervous. So
how important as a US trader is it to look at a currency versus other currencies as well? For example, the euro is having its best year versus the yuan since 2014. Do you find that structurally important if you're like a US based trader?
Yeah, it's always good to look cross currencies. So in trading, we say in foreign trading, a pair is a currency against a dollar. A cross is a currency against a non-US dollar. It's important to look along the crosses, just so you know, when the market is very volatile or there's a lot of event risk, as there is right now, sometimes it's better to stick to the pairs or a currency against a safe haven, like a currency against the yen, which is another safe haven, which is now starting to perform very well. Also, you don't want to, in times of volatility, you don't want to get too fancy with the crosses.
So you mentioned that we're above 117. I think I saw 117.34 last.
Yeah.
What should I do with my euro position? What do you think I should start scaling out of it? Do you think it's the kind of thing where you trail it? I mean, how far can this go?
You know, I had originally thought if the agreement came to fruition, this is prior to last weekend, that we'd be in a new trading range. We'd be 115, 118, and we got there really quick with the agreement. We're almost at 118 right now. I think we may shift like 118, 120 even. So I would hold it. I would take a little off. But right now, the euro is benefiting from positive euro. It's benefiting on both sides, positive euro sentiment and negative dollar sentiment. So that's what's really combined boosting it. So if we see anything this week that the dollar starts to strengthen, which would kind of be a risk aversion move, then you'd want to start scaling out of that, you know, taking a little bit off of that euro position. I will have to say, if you saw markets on Friday, everyone, in currency land, it was really interesting because US equities, the three indices, you know, Dow, S&P, NASDAQ, they were all down for the day and down for the week. But interestingly enough, the commodity currencies still outperformed the dollar on the day. And that was a little bit of a breaking of the relationship, the inverse correlation between US equities negative and dollar stronger. That did not happen on Friday. And so we need to watch that correlation further to see if it further breaks down. What it's kind of obviously gold is really performing, as you mentioned before. So the safe haven seems to now have switched from the dollar, continuing into gold, and now switching into the yen, which we need to watch very carefully. That had not been the case earlier last week.
Okay, last thing on the euro, because I want to give you a chance to talk about dollar Canada. You talked about dollar Canada earlier this morning. And 5 years ago, Mario Draghi said we're going to do whatever it takes to essentially save the euro. So is that what that is? That package is showing that even without Draghi, they're still going to do whatever it takes?
Yeah, that was an epic speech by Draghi, the 26th of July, and it led to massive short covering in the euro. And this is kind of the whatever it takes moment on the fiscal side for the EU. And it's coming 8 years almost to the day of the Draghi speech. So yes.
Dollar Canada, what do you think? We got like a minute left.
Okay, so it's just breaking big levels. So if you're looking at spot, it broke downside support at 134. And if you're looking at the future, the 6C future, the CAD dollar, it broke 74 resistance topside. So I think it'll go to 76. So we have dollar weakness and commodity currencies strengthening. And I think as long as the dollar stays weak, Canada's got legs.
So you want to be long Canada if it continues. Perfect.
Yes.
Amelia, we're going to do whatever it takes to keep you coming back on this show. So thank you so much. Where can people find you?
They can find me at marketcompassllc.com. They can find me at Amelia Bourdeau on Twitter. And you can find me on Instagram story at Market Compass.
So we've become friends. I look forward to talking to you again. I really appreciate you being on.
Thank you. Thanks for the invite. Thanks for your time. Thanks everyone for watching.
We will be right back, guys. We've got Bill Baruch from Blue Line Futures and Blue Line Capital. We'll be back after this quick break from the CME and E-Trade.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
Welcome back, everybody. We are bringing in now Bill Baruch. Bill Baruch is a regular CNBC contributor. If you ever have CNBC on, you'll see him on there and you'll recognize his glasses, his hair. He's got everything going on. Bill Baruch, Blue Line Futures and Blue Line Capital. Before we get into the markets, because you and I've got a lot to talk about, you sent me a lot of information. So just tell everybody what you're doing with Blue Line Futures and Blue Line Capital.
So Blue Line Futures, we're a futures and commodities brokerage firm. We work with clients from novice all the way. We got professional traders, people that are on or were on the CME floor working with us. We put out institutional type content daily, covering markets from the S&P to corn and cattle. In soft markets, we provided a trade desk that's here for clients to, again, talk to us as much or as little as they want. We got people that are calling in right now that don't have any exposure to gold and silver, and we're kind of holding their hand what to do in a market like this. So we also have technology, put all that in your hands. Now on the Blue Line Capital side, we're a registered investment advisor. We work with clients to help put their portfolio together, look at the retirement portfolio, understand what their goals are, what they need over the long run. Very boring stuff, but it's very needed and for people out there.
Is there an active investing component to Blue Line Capital? That's something I've been interested in lately, because I think especially with some of the things a lot of us think are going to go on in the next couple of years, unprecedented central bank globally, intervention, treasury, corporate bond buying by the Fed. Do you have an active component to your wealth management?
Well, what we do is we break down have a diversified portfolio. You know how it works. You got a certain amount put towards stocks and bonds, and then what we do is we have the blue line opportunistic bucket as well, where we may go long and short on different ideas. So that's what we're working on, and some of the things that we've liked this year are across the board. A big emphasis on software, but at the same time, you got to be careful in the environment out there. Again, I mentioned the word boring. This is slow, boring stuff. We're not taking large risks out there. Very calculated, and that's what you need to be in that type of portfolio. You hear people talking about it, buy this stock and put your money into here, and yeah, it's nice to have your account where you're taking risks and speculating in different types of stocks, catching big moves, maybe doubling your account on a rise in the equity market like this. That's not really what you want to look at in your retirement portfolio. One thing to think about, if somebody gave you a loaded gun and it said 1 in 1,000 chance of shooting yourself, would you do that with your stock portfolio? And that's really what one way you got to look at it there too.
All right, we got a lot to talk about. So let's get into, I've already talked about the headlines, both with Scott and with Amelia. You know what they are. What do you think of the S&P Mini?
Well, right now, we did have a wave of weakness last week. I write research each morning. I mentioned the S&P was one of them. I personally author that. It's the Morning Express, Blue Line Futures, put it out each day. And in our research, we have a bias. And it goes everywhere from bearish all the way to bullish, but with neutral in between. We are typically cautiously bullish in the S&P. The market's been rising, but cautious because we don't know what factor is going to come out each day. You have to manage your risk when you're trading leverage. I did go cautiously bearish last week on that wave up to about 32.70, 32.80, just expecting some frothiness. We've seen some volatility with earnings. Got big tech this week. Some of them started last week, and that does bring that volatility. We also have U.S. China back in the mix, so we did go cautiously bearish. We're continuing to hold that cautiously bearish bias right now. Now the S&P did, just because of a new day and a steep trend line, did move below a trend line from the March low. So you could draw that all the way up from March. I think it was the June low, if I remember correctly, that it hits against. Today's open will be below that trend line. So it really matters what we do there today. We have major 3-star resistance, 32.26, 32.29. Staying below there, the bears are in the near-term driver's seat.
So give those levels again and kind of what you would do toward those levels. I don't want to dismiss that.
Yes. Yeah. So if you followed us, taking a cautiously bearish outlook last week, you wrote it down. Ultimately, you want to potentially still either you took your profits going into the end of the weekend, which we always encourage. Sometimes on these markets, especially in the S&P, you don't know how things are opening up. But on a Sunday night, but 32.26, 32.29. It gives you a reason to stay short. If you want your stop above there, we start moving through there, this thing could run back up a bit. So we will hold that cautiously bearish bias below 32.26, 32.29. And when we put that out, our downside target was 31.69, 31.83, which we didn't quite get there. And we have strong support in front of that, 31.90, 31.94, two close levels, but there's just a lot of support down in that area. And we may get there, but again, you don't want to squeeze the last bit of drops from the orange.
All right. So you also wanted to talk about, I believe it was copper, and I'm going to ask Jesus to put up Bill chart 2, which is the copper chart. Can you kind of discuss what you were seeing with copper? Because I think that's a super interesting thing from my perspective, at least.
Had a very strong run, and I think what we've seen is that Asia and the Far East were really some of the first to come out of the pandemic. You start to see demand renewed. Obviously, too, there is a supply worries with mines in Chile that have driven this price up. But we've seen China actually show growth in their recent GDP numbers, and overall around the world, the demand's coming back. Stimulus has been out there. This is why copper has risen all the way to $3. I mean, it was down below 2, all the way to $3. There's some historical resistance levels at $3. However you want to look at it, different price levels, different market profiles, as well as some trend lines you can look at $3. I think this move is a little overdone. It's sort of in line with their cautiously bearish bias last week in the S&P as well. You got renewed China-U.S. tensions. I think that's not talked about enough right now. I think there's, not to go on a tangent, but I think there is an outlook that the U.S. or in the U.S. that President Trump is not going to push on China too much ahead of the election. But I do think, again, copper's overdone here. One of the ways we were looking at that last week, and I talked about it in one of my videos out to clients, is we're positioning short in copper using a put butterfly with a kicker. One of the things we were going past the September option expiration in that, just to give a little more time, a little less liquidity in October, but we were doing a put butterfly, a 285, 275, 265 put butterfly, which is traditional butterfly. You're 1 by 2 by 1, and you're selling 2 of the 275s in the middle. We actually bought an extra 265 at the bottom. It's about 3.5 to 4 cents, maybe a little more than 4 cents right now, which costs you about $1,000 to get in. Holding time frame on that is about 2 to 3 weeks from now.
I love that one. Let's take a look at Bill chart 3, which is going to be silver.
Okay.
Are you looking at the Robinhood owners of silver index like a lot of other people are?
I haven't watched it so much because I do have some of my roadmap already laid out for this move. This is something we've been extremely bullish at Blue Line Futures and silver and gold and Blue Line Capital for that matter. We have gold in all of our portfolios, but really looking for this move to happen. U.S. dollar weakness really fueling it, and looking at historically what silver's done in the past. We've seen silver all the way at $50. I think there is legs in this. But we're getting people calling us almost every day now saying, I want to buy silver, I want to buy gold. And you know, if you haven't been in it, you really want to take a more cautious outlook here in the sense that this is really the front page news. Everybody's buying it. You mentioned the Robinhood holders. So you know, it's good to have silver and gold exposure, but I always say you never want to chase gold and silver when everybody's screaming for it. That's when you want to capitalize on gold and silver that you already own. So I want to say, where's resistance in silver? $26, 26.5 is a big area of resistance. You look historically, that's the 382 retracement from the low. We actually made a new low in March in silver on this leg down from $50. And that 382 retracement is 26.5. Previous lows before breaking down or the way down from the $50 move was about 26.5. Good resistance up there at 26.5. What I want to see is a pullback. I want to see some construction. I want silver to show me that it can hold ground. Now, in 2016, when Brexit fears were out there, silver spiked up to about 21.5, $21. So you look at that area, I want to see it hold out above there. We have some other technical indicators aligning there. So if silver can pull back, hold about $21, I think that'd be really constructive. And potentially the next wave, either if it gets 26 here or not, but hits 26 on that next wave, maybe up to $30.
Gold silver ratio, Billy. Typically, I shouldn't say typically, historically, going back to forever, the median of that was about 65, 55, somewhere in that range. So when you're talking about the gold silver ratio, went all the way up to 114, back down to 95. Is it a factor anymore? Do you care?
You know, it's definitely a factor because even at times that I thought gold was going to be outpacing silver after that spike in that high, the ratio in March, that ratio really never came back up. It showed you silver was doing some construction. So it's not really a ratio that I want to trade, but it was a ratio that showed me that silver was lurking higher, even though it was underperforming, it was lurking higher, and this move was something that was in development. So I think it was important to watch that because it's ultimately set the stage for this surge in silver.
All right, IGV is the next chart. That's going to be Bill chart 4. What do you
breaking down there. And you got names like Adobe, you got CRM, which is Salesforce. Microsoft is in there. You got Intuitive, QuickBooks, which is Intuit, in there. You got a lot of software names in there that I think are really the backbone of stability within that sector. So if this thing can continue to hold and stay within that channel, I'm very hopeful for the market, even though it's cautiously bearish in the very near term from an investment standpoint, very hopeful for the market to continue this overall move higher.
So do you want to buy the actual ETF? Are you looking at options on it? What are you looking at specifically?
I like just buying the actual ETF and having that in your portfolio. I think it's great, give you the diversified across the software. You don't have to worry about the idiosyncratic risk and being heavier on one name and missing some of the others. It's a very good diversified name to have in there.
Billy, where can people find you if they want to find you?
Well, bluelinefutures.com is the best way to find us. We put out research up there each day. We put our videos. I got partners putting up videos as well, talking about markets. So we cover everything, like I said, the S&P and gold to corn and cattle. So you'll find out a lot of content on there, actionable stuff. bluelinefutures.com. We have platforms to check out. And again, you sign up for a 14-day trial of our research. Check it out, and then someone at our trade desk will speak with you and see what you're doing in the markets. And you always bounce off ideas from us here too.
Billy, thanks again for joining us, man. I really appreciate you coming on, taking time out of your morning. I know you're a busy guy running those two companies. Bill Baruch, Blue Line Futures, Blue Line Capital. We're going to be right back again after this quick break. It's a less than a minute and a half break. So stick with us because we got Jimmy Iuorio, and we're going to check if he has pants on. See you guys in a bit.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
How's everybody doing? We are back. A little delay there because we had to make sure Jimmy was fully dressed. If none of you know what I'm talking about, Jim Iuorio, Managing Director, TJM Institutional Services, one of the most widely seen CNBC contributors, really good friend of mine. I've known Jimmy, God, 26 years, I think, somewhere in that range. Jimmy had a spot on CNBC where Becky kind of teased him a little bit about the show was over, right, Jimmy? I mean, we're not live. But Jimmy was at his home as he is now, and he was in his shirt and he had no pants on below, and he stood up and the control room saw him without pants. So we don't need to dwell on that. It's on Jimmy's Twitter. If you guys want to see it, it's pretty funny. Jimmy, give your Twitter now so people can look at it if they want.
At Jim Iuorio, JIMIUORIO. And I'll tell you this, that as a general rule, I tend to wear the minimum amount of clothing required. So I'm not going to even suggest if I have or have not pants on right now.
Well, it's funny. You actually inspired me. I just had my cousin text me and say, your viewers want to know if you're wearing pants. So I do. Can you see? I have pants on.
Oh, good. Okay, good.
Yeah,
That's
but
good.
it's
Each
an
his own.
inspiration from you. It's not
Pants are
something
fine,
I
right.
normally do. Normally, I wouldn't have pants on either. So Jimmy, macro story. We went over the headlines with everybody already. Don't need to do it again. We've got no, I'm about to do it again. You know what's going on. I'd like to get your view on the jobless, whether there's going to be an extension of the 600 or more, if that stuff's going to get done, because I know you're a Fed watcher and that makes you a government watcher, but not a political opinion. Do you think it'll get done? And if so, is that part of why we're coming back a little bit today?
Right. Well, that's what I was just about to say is regardless of what you and I think, it seems like the market thinks it's going to get done. And I think that's one of the reasons that the stocks are hanging in. It's one of the reasons that the dollar is still cratering. And by the way, everybody seems to be talking about gold and silver. And I've been talking about gold and silver for months, as you know, but it's really more of a dollar trade than everything else. And the dollar is, cratering relative to its movement over the last few months. So that's really the trade. So to answer your question, yes, if the market tells me they think it's going to be done, then I believe it's going to be done too.
So Scott Bauer said that he believes this is the sell-off we had Thursday, Friday is a little bit of profit taking. I don't see us robustly coming back right now. I mean, as we're talking, I'm looking at the Dow only up about 16, right?
Right.
So you've got the NASDAQ, I'm looking right now up about 1%. Was that profit taking on Thursday and Friday in your view?
I think so. Last night when I wrote out my Sunday notes and you read them, what I worried about was the disconnect between gold and silver and the stock market that began on Thursday. Because
before you go into that, let's put up your chart. Let's
Okay.
put up that Jimmy chart one so you could talk about that with the chart on the screen, because you sent me a really nice screenshot of that. So it's up on the screen now.
Cool. So my belief when that began to happen was that we could be in for some trouble, because I believed that was telling us that the Fed's response to this and the government's response to this have limitations in risk assets. And it seemed to me that there was somewhat panic buying in gold and silver, and that was going to continue. And then I thought that, and it all starts with the big six names in the NASDAQ. When people start selling those because of market position is huge, and that trade could have been huge to the downside. But now we come to this morning, and maybe it's the sun coming up, but I look at the way we've traded and handled those things, and I think it feels pretty good. Also, Goldman comes out with a piece talking about the weak dollar is going to attract $300 billion of foreign investment into U.S. assets. And so when Goldman says something like that, people feel good about it. The market's telling me there's going to be a deal met and extending benefits. So to me, I think the stock market looks okay. Now that will all change with me if the stock market, if the S&Ps trade below about 31.85. But until that point, I am relatively bullish. And you're going to see from the trade I'm going to give that it's a very, very conservative bullish expression. So it's not like I'm going to just be like, all in like some cowboy buying it, but I'm still a little bit bullish.
So it's funny. Normally, I don't like to spend this much time on the, I do like spending time on gold, silver. I love the commodities. Normally, I don't like to spend that much time on currencies, but I think they're critical right now. So same question to you that I posed to Amelia. Goldman says that, it's not you saying it, it's Goldman that says it in that note. And I saw that note that's going to track money into the US. The original thing I learned when I was learning about currencies 27 years ago was that when you buy a currency, it's like buying a share in that country's economy. If you look it up on investopedia.com, which I use a lot, it's still there, right? Do you think that flies in the face of what Goldman said, if you believe that, as the NBER has said, that we're already in a recession?
It's so funny with currencies, like you said, because there's always the two-sided arguments of whether it's good or whether it's bad, and whether the movement itself is being driven by good or bad things. So you see the dollar weakness, and the dollar is the world's reserve currency. I don't think that that's going to change. I think that that's the worry, the far-reaching worry of the dollar, like there's going to be some sort of cataclysmic event, I think is probably not even in the picture right now. But the fact that we've broken so hard is definitely the world telling us that there's a lack of confidence in how far these policies can go. With the Fed's doing rates, the government just spending like a drunken sailor. So that's what the market is telling us is a very negative thing in the commentary of the United States. And the euro is leading sharp on the upside, and the market's telling us that they're further along and better suited, I guess, to recover their economy post-pandemic. So what I see is bad, but then Goldman coming in and giving the silver lining, I think is a nice reminder to people that it's a double-edged sword.
So let's switch gears then. And before I do that, I do want to tell people that the CME does have the micro FX futures now that are 1/10 the size of the other contracts. It's a very good retail product. You've got euro, you've got yen, you've got pound, Canada, Australian dollar, and Swiss, all available in the micros. But I want to switch to your trade because I think that's critical for what's going on in the market right now. We're up a little, we're not up a lot. Last show, you did a broken fly that made money. You're looking at another broken fly now.
Yeah, if it ain't broke, don't fix it. And I don't mean to bore people with a similar type of trade again, but these are the trades I've been having the most luck with on the upside. Because again, as I say, I want to find my risk. I want to be able to sleep at night. So one of the things I have on, and I have a few things on for upside. It's the week 1 August. So that expires August 7th, a week from this Friday. The 3250, 3300, 3335 call fly. So that's buying the 3250, 3300 call spread. So you're buying a 50 wide call spread, and then you're selling the 3300, 3335 call spread. So you're buying a 50 wide, you're selling a 35 wide. So you have like 15 ticks residual in case it flies through the upside. You're not going to lose everything you put out. I bought it for 12 ticks. I actually got it a little better than that, but just to round it out, 12 ticks is $600. So $600 to make $1,900. That's making $1,900 if it goes to 3,300 and you covered at that. When you trade flies, that is almost never going to happen. I have certain like little rules on flies. Like if I double my money in the first third of the duration of a trade, or the first, even a little longer than that, I probably would just take the double and look for the other trade, because it's really, it's folly to try to wait to capitalize 100% on a call fly. But again, so a regular, you got to think of a regular call fly, you're kind of pinpointing a spot. And I know you know this probably, but in a call fly, when you start weighting it different ways, it expresses slightly more bullishness than a regular call fly would portray for me.
So when you say you're risking 600, that's the risk. To make 1,900, you're saying that's just like the textbook definition of the risk and reward on it. So, and I like that you go into detail like that. Explain people, so people will hear call fly, people will hear call condor. Just take a second and explain to people what the difference is.
So a call fly is literally like an equal weighted call fly, equal distance. Let's say the 3250, 3300, 3350, which is not the one I have on, but that's a 50 wide call fly. And you would make your most money at 3,300 if it goes, because that you're making all you can on the first call fly and not losing any money on the second call fly. A call condor separates those middle things. So you're buying, for instance, you'd be buying the 3,250, 3,300 call fly and then selling the 3,325, 3,375 call fly. So it would be a 50 wide call spread condors, buying this, but there's 25 ticks in the middle that anywhere in that range, you could make the full amount of the bottom call spread. Now, what's going to be is that you're going to pay more for that. I mean, the market, is relatively fairly priced on most things. So it's not like you're going to get a gimme here to have that 25 tick range for maximizing your money. You'd have to pay out for it.
Is there volatility adjustment when you do these trades?
Yeah, I mean, there is. It's not huge because you're buying and selling. So I don't care that I do these types of trades in any sort of volatility environment. But then, if it's a high vol environment and you are doing a broken fly that's more bullish, you're going to be paying more for that. But again, for equal weighted flies, I don't worry about it too much because you're buying and selling volatility.
Your full-time job is at TJM. So these are kind of good trades for people who are like, you know what, I want to do something today because I have an opinion, but I got to go to work. I got to go to my accounting office, or I've got a trial today if you're a lawyer. That's good for that kind of person.
This is exactly why I do it. And you hit upon it too, because I love to trade and I trade every day and I day trade often too. But I prefer like 2-week trades because you can do that. You can set it aside. You can go back to the other things you're doing. And what the other things you're doing, I'm working with clients too. I'm not just always managing my own stuff. So there could be hours at a time where I'm looking at clients' things and not even looking at my own things. So this is exactly, put it right in the head. The most you can lose in this is $1,200. I mean, is $600, 12 ticks, and you have 2 solid weeks to do it. And it doesn't require that much management. Now, as we start to get closer, the fun part is the management. Like I said, we're not going to take it to 3,300 and plan on having that settle on that 2 weeks from today and making the maximum. That's just unrealistic. But as we get closer, you have to put a little more time into it.
So Jimmy, real quick, you guys at TJM don't really take individual retail accounts. E-Trade does, by the way, our sponsor. But where can people find you? Your Twitter feed is entertaining as well as informational. So is that the best place for people to kind of interact with
That's
you?
the best. That's for interfacing with the public. That's what I've been putting my most resources into right now is at Iuorio on Twitter. And each day I put out the things I'm looking at. Remember, again, I'm underscoring this. I don't give advice to anybody because I don't know what people's risk parameters are. I don't know how they're set up. All I do is I tell you what I'm looking at and why I'm looking at that. And then everyone can make their own decisions. That's what I do all the time.
Trade examples. That's what you're giving out.
Exactly. Yes.
Jimmy, thank you again for being here. We always love having you on the show, and we're going to keep having you back as long as you'll have us. Jim Iuorio, follow him on Twitter because it is absolutely informational and hysterical at the same time. Go check out that Becky Quick video, man. Go check that, Becky. We're not going to ask you to stand up, buddy. But thanks again for being here, man. Jim Iuorio, Managing Director, CNBC contributor, TJM Institutional Services. We'll be right back. One more quick break. We'll round out the show with Mike Arnold, who's got some very specific trades, very specific charts to show. He is my business partner and friend of multiple years. We will see you guys after this break. Stay with us.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
We are back. Thanks for sticking with us. With me now, I've got Mike Arnold, who is the Chief Technical Officer and co-founder at Path Trading Partners. One of the best technicians I know. He's also a friend. He's my business partner. And I want to bring him on now because, Mike, we're not even going to talk about macro. You don't care about macro. You're a price action guy. So let's go into the charts you've sent out right away. I mean, you want to look at NDX, which is a NASDAQ ETF or just indicative of the NASDAQ futures. So why don't we put up your chart? You can say hello so people can see your face moving and stuff.
Hello, everyone. Thanks for having me, Bob.
Yeah, let's do NDX. Let's put up that NDX chart, Jesus, when you can, and talk about what you're seeing in that first chart.
Well, NDX Daily, finally last week, we had a double top, one of my favorite, double tops and double bottoms are one of my favorite reversal patterns. So double bottom for bullish, double top for bearish. We finally confirmed the double top, but we have not triggered it yet. It was confirmed on Friday. Even with today's rally, it is still in place. We could rally up in the NDX NASDAQ 100 index to about 10,900 before the pattern is invalidated. If we do get a close below 10,370, it is triggered, and then we have targets around 10,020, so 10,000, 9,850, then 9,672. If you go to the weekly chart, what's interesting is we have another concept we use called a rotation zone where we watch for pullbacks and rotations back up for continuation moves. The NASDAQ on a weekly basis, if this went to full target, would only take us back to the bottom of the weekly rotation zone and only prices that we were last at June 15th. So this is only correcting a little bit of the last move. Not a huge correction, but it is indicative also of momentum waning in the NASDAQ. So even if this continues to rally and starts moving more sideways, we do have major waning momentum. And this is the first time we've really got a pattern that's broken the daily rotation zone. The last couple, like we had a sell on June 23rd that actually just went to the bottom of the daily rotation zone, then rotated up very, very strongly to help form this double. I also put out charts.
We've got the weekly chart up. So explain the rotation zone really quick so that people
The rotation zone on that weekly chart would be to the bottom. The top yellow line is the first layer of support. The bottom blue line is the major level of support. So we'd watch for a pullback in there and then a potential reversal move back up. But you can also see, even if we got to that blue line area, that we're still only trading back to the highs of February before this sell-off occurred. So it's not wiping. What was that?
It doesn't take us into another bear market. It's just a
rotation. No, it's actually just correct. We haven't even had a normal correction since these lows in March. We haven't even had a pullback to anywhere close to the bottom of the NASDAQ rotation zone. What's interesting, I also sent over charts of Amazon.
You want to look at that now?
Sure, we can look at Amazon because Amazon also confirmed but not triggered a double top. And Amazon's actually acting pretty strong today, but it's still not invalidated the pattern. So Amazon's double top would only take us back if it went to full target. The higher probability target would take us back to 2,600. The second target, if we had a bigger pullback, would take us back to 2,500. And that's price action that, again, that's only retracing to the beginning of June. I mean, so that's not a huge retracement.
It's one of the things we've talked about a lot in the past is that some of these moves don't have to be catastrophic. It's just normal market rotation that almost solidifies specifically institutional buying, right?
Yeah, exactly. Even if these patterns trigger, at some point we need some kind of pullback, and we have to wait for the pattern to trigger, but we're definitely getting some changes in the core stocks that have been driving this. And I also put up a Microsoft chart, which is actually—
take a look at the Microsoft chart.
Weakest ones right now. And that price action, if the targets, again, would take us back to about 190, then 186. And Microsoft, that would take us back to close to February highs before the sell-off and the bottom of the weekly rotation zone. So these would just be normal corrections at that point and not major severe corrections to actually work off some of this major overbought condition. They have not triggered yet. They've confirmed, but they have not triggered.
Let me just explain that really quick, and then people can, you can correct me if I'm wrong. When something is confirmed, that means the pattern is in its existence with the proper parameters around a pattern that you can get a measured move. When something is triggered, that means the pattern is now in effect, and it's a high probability that those measured moves are actually achieved. Is that correct?
That's completely correct. And a lot of people, where we separate ourselves with a lot of our systems and trading stuff, is we actually have that dual layer where a lot of people would normally trigger it when we confirm it. But especially in these kind of markets, when you trigger it before it actually triggers with our systems, it can lead into some catastrophic results because many of them have been stopping out just off the confirmation and they never actually trigger.
So you're also the chief portfolio manager at the stockthinktank.com that we are partners in, full disclosure. You can find that at the stockthinktank.com. You got us long gold June 1st.
Yep.
So what do you see in gold right now? And Jesus, if we can put up that gold chart, that'd be great.
Gold is getting, we are long, as you said, it is getting quite toppy. We just went through our major target areas, which were about 1960 to 1962. We've traded through them today. The next ones, if I update it right now, real time, we'd be looking on a continued rally. We're up to 1990, then 2010. Now this is very overbought. We are aggressively trailing a stop because I am looking for an exhaustion pattern this week. And then that's where we start watching for a nice pullback in gold. We'll still remain very bullish in gold, but it is extremely overextended. And if it were just to return to the weekly top of the weekly rotation zone, we'd be only looking for a pullback to about 1860. So, which would be a great little area to reload. If it dropped below that to the bottom of the weekly rotation zone, we'd only be looking at a pullback to about 1780, which would be incredibly, if I could get a pullback to there, that's an incredibly bullish pattern. So short term, I'd like to see the pullback. We're waiting for actually a trigger for that exhaustion pattern. And then it's just pullbacks to these longer term key support levels and reload on gold. And silver is getting also extremely, extremely overdone and close to also triggering an exhaustion pattern.
Let's put up the silver chart, but I know you well enough to know the answer to this question, but I'm going to ask it so you can answer it. When you say, I was on BNN Bloomberg last week talking about gold, and I told them that I easily can see 2000. You just mentioned that our two targets kind of framed 2000. It was about 1990 and 2010. But if somebody has missed it, has not been in, the pullback is where you want to get back in.
You want to get in on the pullback.
Right, so let's look at the
I would not be chasing gold or silver at all here, because when it tends to get this overextended, we do get that really nice pullback. It's just trying to time it correctly. When you have, people are chasing it right now, and you don't want to chase this higher, because when it exhausts, it can correct pretty quickly, and that's when you want to save your powder for.
So really quick, what do you think about silver specifically?
Silver, our targets we had targets of about 2470. Next major area is 2540 to 2553. And then if this does continue, next major target is 2692. What we're watching though is a key support on the weekly is all the way back at about $21 though. So this could easily return to $21, which would be a great area to buy. The area in front of that, if it doesn't get pulled back all the way, we're good. Next area we're watching is 2250.
So real quick, do you care about the gold silver ratio? And we're also along the euro since about June 24th. How are you feeling about that? We don't need to see a chart, just quick because we're running out of time. Give me answer those two questions and then tell everybody where they can find you.
I do care about the gold silver ratio. I'm going to be, once we do get a pullback in gold and silver, I'm going to re-baseline it and then figure out how we're going to weight the portfolio appropriately between the two. In terms of the euro is also getting very, very extended. We are long the euro in the portfolio, and it's with a trailing stop, and we're getting more aggressive with ratcheting up that stock because of the recent price action, especially with the explosive move higher last week.
Mike, where can people find you, please?
They can find me at pathtradingpartners.com. They can also follow us on Twitter at path_trading. Those are the two best ways. They can email me at support@pathtradingpartners, and I will take a look at those emails. Also, we do have a YouTube channel. We put out videos every day, free videos for people to help with learning technical analysis and some price action trading.
Yeah, if you like the price action stuff, Mike just pointed out, a lot of it's going to be on his Path Trading Partners YouTube channel. Mike, thank you very much. And again, I want to thank E-Trade, the CME Group. I want to thank Scott Bauer, Amelia Bourdeau, Bill Baruch, Jim Iuorio, and of course, Mike Arnold. Thank you everyone for watching again. We've completed another show and you've just been exposed.